What's up YouTube? Jake here. I'm going to go over how you guys can be trading with precision and knowing exactly where the market's going to go and when. So we'll start with this kind of theoretical example and then get into an actual example from last week. So to start, we have our initial consolidation here. We have our internal manipulation starting this buy model to our max expansion of this standard deviation of this leg, right? Now, when we reach this deviation, we see that we have accumulation, we have manipulation of these highs, and we now start a market maker sell model. We have buy side of the curve, and we are starting the sell side of the curve. Now, let's just say that this manipulation and start of our distribution happened during London, okay? Now, we are expecting that New York, when it opens, is going to continue this market maker sell model to our intended drawn liquidity. So we're assuming that we left some sort of high time frame P right down here, maybe equal lows, maybe a high time frame for value gap imbalance. We're expecting that this will be our drawn liquidity. And what we're looking for is we're going to mark out our deviation from the swing high to swing low of the manipulation of the highs. We are then expecting a reversal in our negative 2.5 deviation to come then and retest this change in the state of delivery in this initial imbalance, right? So here we're looking to see another rejection off of this, and we can now draw a deviation off of the leg that traded into this level to then send price lower to get new projections for where this retracement will be. We can expect that this will sweep out this internal low and likely trade back into a PD ray that was left here. Now we can be looking for another internal change in the state. We can be looking for a higher time frame rejection wick, like an hourly rejection block, 4-hour rejection block, or just an imbalance in price here. Maybe VWAP is aligned. And along with that, we're looking for the 10 a.m. 4-hour candle to open somewhere around these lows. So we are putting that top wick on as we manipulate into this level to then complete that final expansion to our sell side. So I know this can, look complicated, but we'll get into an actual example from Friday. So this here was Friday, October 3rd. Now, we have right here off the bat, we have these equal lows that are left. And we see that we have this manipulation leg here, which starts this market maker buy model higher. Now, this takes price into our -4 expansion to also sweep out this buy side liquidity. Okay, so once we see that during London kill zone, this buy side has been taken, we are not necessarily expecting higher prices going into New York. Now, we see that within this deviation here, we get this accumulation range, manipulation of the high. We inverse this gap and also close through this right here, which is the leg that started this move up to sweep liquidity. So as soon as we see price close through this, we are expecting lower prices. Now, like I said, using our deviations from this manipulation leg right here, we see what does New York AM do? New York AM pre-market is going to reverse in this deviation and start its move higher to retrace to retest this change in the state. Now, New York Open is right here on this candle. New York Open pushes up into this deviation of this new leg, as well as this change in the state and this imbalance, and it strongly rejects. Now, what does price do? Well, we draw a deviation of this leg right here, which I can show on the 1 minute, but deviation there, down into our max expansion. Now, we expect another retrace. Now, why are we expecting price to potentially come higher? Because our 4-hour candle opened right here. And we know if we want to send price lower, we're going to see price come up and fill more orders in this imbalance to expand lower. Now, looking at the 1 minute, we have manipulation leg right here, swing low, this candle that swept liquidity. We have our deviation right here. Now, what else do we have? on the 1 hour time frame, we see this large rejection wick right here. Now this wick, why is this a valid wick to use as a rejection wick? Well, this wick swept this high right here. It tapped into this imbalance and also respected it bearish. And we also generated this engineered high inside of this wick, right? So as we come up to tap into our level, we are also sweeping out this liquidity, which makes this a very valid wick. Now, what I'm looking for on wicks is price to respect the 0.706 level. Okay, so that's what I'm using for wicks. And as you will see, on the 1 minute, we have this large fair value gap right here. And on the 5 minute, we have this order block, right? So clear demand there. We know price will likely reject this area if it does trade up to here. And as you see, when price does trade into this level, we are waiting for reactions. So we see a large rejection wick. We've just recently swept out this internal high. As soon as we see a closure below this recent last down close candle right here, we can either enter short there, or we can also wait for a retest of that swing right there. So after we see price tap into it and reject with this order block, we can enter a short. So we'll just say that the short was taken somewhere around here after, getting confirmation. You also can, when you have so many confluences, enter with a limit order, put a limit order on your 0.706, but we'll say we waited for confirmation. And then using this, we are looking to deliver to these relative equal lows as mentioned, and this unfilled daily fair value gap, which was right here. So looking at the daily, we see that this entire candle, we swept out previous day high and then distributed to the imbalance in price. Now, you guys can see how when you are not only looking at what's directly happening in the moment in New York, but you're also looking at what moves started to get us here. What did we do prior to New York Open? What did we do during London? And how is that going to play out in market open? And then once you have that bias and you have a draw on liquidity where institutions are going to want to send price to, right? When we have a big, large daily imbalance, we see that, right, price expanded and left this major imbalance. We know that price is going to want to seek that out. Institutions want to fill large orders there. So we know price will seek it. Now, the second piece is when are you getting that entry, when you're actually finding your entry. And this shows a perfect example of how you're getting an entry while not getting stopped out, right? I know a lot of people may enter off of like this initial move off of this, maybe close under this, and they get distribution to the internal low and they end up getting stopped out just for price to tap into the actual level that we're going to react off to go lower. And there's many parts of this, but you'll notice when you start to look in price in this way, you can trade with, serious precision, because you know that each move and each retracement is not random. They're happening at specific deviations. These deviations are based on math, and price is run by an algorithm. When you understand that price is ran by computers, by an algorithm that is, placing hundreds of thousands of shares at, statistically driven levels using, quantum math, these deviations are allowing you to, get a similar edge as a retail trader to find where these pullbacks are going to occur. And, once you put all of this together with a narrative, you can get, scarcely good entries as seen here. But yeah, hope this video was helpful. Not a super long video, just thought this was a pretty good example to go over and show you guys, how I'm reading price and how the technicals are kind of coming together to, how I form my entries. But yeah, leave a comment, like if you guys enjoyed the video, and stay tuned for some more content.